Welcome to another episode of the Confessions of a Recovering Landlord podcast, where you'll learn the secrets commercial landlords would prefer you not know. I'm your host, Jan Gibbons, along with my co-host and experienced commercial real estate broker, Bob Gibbons.
That's me.
Brought to you by Riata Commercial Realty, where we exclusively represent users of office and warehouse properties. Landlords have representation. Do you? Hello, everyone. Thanks again for joining us today. We're really excited about today's episode, which is a very topical issue. With the failure of banks like Silicon Valley Bank and Signature Bank, we're seeing far-reaching impacts on commercial real estate industry, including commercial tenant rep. That's why we've invited our very special guest today to help us kind of shift through all this quagmire. Ben Parkey is the Executive Vice President and Market President at Texas Security Bank. He's been at Texas Security for almost 10 years. Prior to that, he was the Senior Vice President at Plains Capital. Overall, he has more than 21 years of banking experience. Ben received his BA in Finance and Accounting from SMU in 2002. So, yes, he's a buttload years younger than either of us, but
wait a minute,
it's all right.
Both of
But
us
I look older.
Oh,
you
yes,
look older.
both of us.
I was going to say that you read that exactly like they have it on their website. And I'm just shocked they didn't also say that he won some beauty contest somewhere.
Ben, you don't have to take that from him.
Well,
You take it off air.
Ben and I have known each other for a while, and we've been in a few business groups together. And so we've taken a little ribbon from each other here and there, and he can dish it just as easily as he can take it. So don't cut him any slack.
Well, I hope so. He agreed to come on this show. He must have some.
Fortitude.
Okay, thank you.
All right. So no, seriously though, I really admire not only Ben, but the company, Texas Security Bank, because, there's a lot of banks around, and I know a lot of bankers, but few bankers have the real entrepreneurial spirit that a lot of their customers have. And so, one of the reasons, you talk about Silicon Valley Bank in the intro. So it was known for banking tech startups. That was their niche. Mm-hmm. Well, if you're an entrepreneur, there's no better bank for you than Texas Security Bank, because guess what? It's owned by a bunch of entrepreneurs. I mean, Ben's an owner. He's, you gave his titles, but the title that matters to me is that he's an owner of the bank. So whenever I send a client to talk to him, I know that that client is an entrepreneur talking to an entrepreneur about how to solve business problems and issues and needs. So that's the real thing that matters to me when it comes to Texas Security Bank and Ben in particular.
So not all my flowery stuff. You're not interested in any of that?
Yeah, not really.
Okay. Okay, so, Ben, let's get to the heart of it.
Okay.
Yeah.
Thank you for coming on board. We're so tickled to have you with us today.
Yeah, well, thank you for inviting me. And certainly I feel the same about y'all. It's not Bob's charming personality, clearly, that keeps bringing me back. It's the fact that you are a landlord, an ex-landlord who understands it, who now represents tenants. And it's much the same way that we're entrepreneurs out there trying to help entrepreneurs. And when you're trying to help somebody else out, it's certainly beneficial when you've walked in their shoes before. And I think, all of us here in this podcast can say that we've done that, which is a distinct advantage, in my opinion.
Exactly.
So tell us, what are you hearing from your clients, or are you hearing from your clients?
I am hearing from my clients, and the unfortunate or fortunate timing was last week was spring break for many of us with younger kids. So I was out of the country.
That was totally accidental, right?
Yeah, totally accidental. And so I'm watching the news is coming down day after day, and I'm going, oh my gosh, what's happening? And actually Silicon Valley, the dominoes started to fall before I left. And I've got a friend over there that runs basically Dallas, wonderful banker. She's amazing, and just started to get kind of some fear and a little empathy of what's going on. And then you watch the whole event take place. And for us, for bankers who've been around a while, it was a little more evident what was happening, particularly to them, than maybe some of the other people that aren't so familiar with banking. And the reality is fundamentally, and by now, a lot of people have had time to read articles and understand what's happening, but it's so important to understand what is the core business that a bank does. Obviously, it takes in deposits, makes loans, but who are you providing those services for? And that's really the centerpiece of this Silicon Valley conversation. Is it started with, who are your clients? Well, they're tech companies, there's some crypto in there, but a lot of them are pre-revenue, pre-cash flow type tech companies. So how do those companies operate? They've got to be funded by a third-party source, right?
Mhm.
And who are those? Well, those are venture capitalists. Great, love it. I love innovation, I love technology. We embrace it here as a bank. Thank God Silicon Valley did all the things they did, and all of these folks were out there courageously creating ideas and technology. But the reality was, as the economic climate was cooling a little bit, the bleed on those deposits, the seed investments, whatever they were starting to deteriorate a little bit. Well, in the previous year, we'll back up, Silicon Valley's deposits had grown exponentially over the course of a year or more. And they took, as a group, they decided, as a board, as a management team, as an executive team, to take a very large swath of those deposits, that excess liquidity, and put it into investments. They didn't need it for the loan growth at the time. So what did they do? They put it into very safe, very prudent investments, which are things like treasuries, right? Now, one of the issues that's easier to see after the fact is there's a couple kinds of maturity or a couple kinds of investments you can make with treasuries. You've got held to maturity and you got available for sale. The majority of theirs were held to maturity type securities, meaning that they were chasing a little bit higher yield. Again, super safe investment. These aren't crazy risky bets, but the problem is you've got to hold on to those investments. So as their deposit base was bleeding down, they needed more capital. The VCs were saying, I'm not sure I'm going to put another round of funding into that particular company, whoever it was. So all those deposits were going down. They decide, well, we've got to sell some of our portfolio or investment portfolio. Well, when you do that, simultaneously, when the Fed is jacking rates at an insane rate, guess what your portfolio is worth? Not what it used to be.
No.
So then you sell it, and then what do you have to declare?
Discount.
Losses, right? When you're a publicly traded company, information is shared pretty quickly, spreads like wildfire. You know, they notified the FDIC and the SEC that there was going to be a loss in their portfolio to the tune of 1 billion. Investors got spooked. Stock price starts dropping, and then you've got the calamity and the run on the bank. Everybody yanking their deposits out, and it happened like that.
And the run on the bank was interesting because, from what I understand, we're now in the age of the internet, and this is the first run on a bank since the internet.
Yeah.
And so it happens far faster than ever before. And I heard that they lost like $42 billion in 24 hours.
Yeah. I mean, there are CEOs of these startups on the ski lifts, wiring all their money out from their phones. I mean, it was wild how quickly. So what typically happens in previous situations like this is there's a little bit of a time frame where there's days or even weeks where it's bleeding down, and there's time for the government, the FDIC, to step in and orchestrate an orderly sale, get the data room set up, and you can get people in there to buy it. This one happened so fast that there was nothing that could have been done in terms of an organized sale. So when a sale like that happens, then the FDIC doesn't have to come in and worry about those uninsured deposits, because a new bank comes in that's got great capitalization, great liquidity, they take over, and the customer base feels confident again about their deposits.
So back to my earlier question, what are you specifically hearing from your clients?
What are they afraid of?
I did all of that without answering your question.
That's all right. We needed
all right. Good.
We needed the backstory.
Hey, Ben, she's going to nail you to the wall. So just get it out of the way and answer the question.
My jam.
Give Bob the afternoon off.
Yeah. So what our clients, a lot of them are calling just saying, hey, what is your take on this? What do you think happened? Why did this happen? And all that. And then so the questions I'm getting answered are, not surprisingly, what are the most recent headlines? What are your uninsured deposits? Well, I'm happy to tell you that, but why are you asking that question? And I think a lot of people, and they shouldn't know, they're not bankers, they haven't been in the industry a long time. You grab onto one line item that really doesn't make sense in context of the whole picture. So a lot of my conversations, Jan, have been about explaining, okay, here's what our level of uninsured deposits are. Well, the next question is, are you worried about that? No, I'm not. Because you've got to look at what are those deposits made up of. We at Texas Security Bank, we're a very commercial driven bank. So a lot of seasoned, mature operating companies that keep a lot of demand deposits. They're not even interest-bearing deposits that are above the FDIC coverage. Those deposits have been here for a long time, and they're not dependent upon a third-party funding source. These are the retained profits of an operating company that's been around for 10, 20, 30, 50 years. So those are different than seed funding for a startup. As you can imagine, the behavior is very different. What if a big chunk of those deposits are made up of your shareholders? They've got aligned interest with your bank. Well, they're not going anywhere. And we've reached out and we've been able to have conversations and explain what a lot of these things are. Our investment portfolio, everybody's investment portfolio, if you invest in bonds and treasuries, is hurting. But what is the makeup of those? Ours, for example, 100% of ours are available for sale. So we don't have the penalty of hold to maturity bonds. So if we need to get out and we need to generate liquidity, we can. We've got plenty of liquidity. It's not a concern of ours at the moment. We're not immune to everything that's happened, but we are in a much better position than some other banks. So a lot of that is just having those conversations with our clients. And the last thing I'll say is we do offer a product called ICS, which many banks offer, but I feel like a lot of bankers, a lot of folks in the industry don't do a good enough job promoting products like this. And the way it works is, back in the old days, we had a product called CDARS, which were laddered CDs. So you put a CD in a bank, say it's $1 million. 250 would stay in that bank. 250 would go to another bank, another bank, another bank. So it's the same program, but now it's with money market accounts, your operating account, whatever it is. So you have 100% FDIC coverage, but from the client standpoint, you're still just dealing with me. You still have one bank statement, but it flows through us to other banks, so you're 100% covered. Those other banks are on the reciprocal end. So they're doing the same thing, sending us $250,000 of one of their clients. So you can see it's just a network that forms that keeps everybody fully insured. So clients that were interested in that, we certainly, put them in that product.
But that's a separate product that they have to opt into. I assume there must be a fee for that, right?
There's a slight fee for it. It's not substantial. So it can be anywhere from 15 to 30 basis points. And typically what you would do is net that out of the interest rate that they're going to receive on their deposits.
Gotcha.
But again, we've had people that have got very large amounts of money with us that said, no, I'm very comfortable with the bank. I want to keep the higher yield. Okay, no problem.
So I heard this morning on a podcast I was listening to, it was a tech podcast, and they were talking about how a company had popped up already to do kind of what you were just describing, but sort of on an automated basis where it spreads it out. So it's all insured at the $250,000 level or less. I had not heard of that being a separate service from a bank. And, I'm not sure who's providing that, but does that sound sketchy? I mean, it does to me to be, having that as a separate business so quickly after this.
Well, what's interesting is the company that provides this is a company called Intra5, and there may be others, but they're the predominant player. They are a third party. They're just aligned with banks, and you enter contractual agreements with them. So to me, what this sounds like is what we saw a lot in PPP and the earnings employee retention tax credits, where these firms pop up out of nowhere, and all they're doing is trying to shepherd you through the process for probably a substantial fee. But I'm not familiar with this particular product you're talking about. But what I would recommend people do, talk to your banker. Hey, do you have a product at your bank that can ensure that I'm fully FDIC covered, insured. Most
So now-
banks will be able to do that.
So now that the Fed and the government has backstopped all deposits, regardless of amount, on this, Silicon Valley Bank and Signature Bank and First Republic Bank now. So none of those depositors, regardless of amount, have lost a dime. Is there any reason why anybody should go with that product you're talking about now? Should we all assume that all of our deposits are going to be taken care of regardless?
That feels like a loaded question, so I am glad. Personally, I'm glad that the FDIC did what they did to protect. The problem with that is, as you might imagine, it can set a new precedent for banks and for clients to act in ways that they probably shouldn't, being risky or not paying attention to whatever it may be. So there's the other effect of that could be, and I hope they don't continue to do it, is the answer to your question. I hope we don't do this all the way across the board, because I believe there's ongoing circumstances that can happen because of that. But they've also got to be careful to say, we're not just going to insure these big banks, because obviously you can see what will happen. People will flee regional banks and small banks, and we're going to end up in a country with 4 banks. And that's not good for anybody. Not good for our economy, not good for business owners, not good for real estate, tenants, landlords, nobody. That's not a good thing. So I think in the temporary and in the interim, it's great to have that backstop protecting those. But I hope long term, we just take another look at this whole program and decide, the best way to go about going forward.
Well, one of the big issues I see in this is that the average depositor, regardless of how much money they have in the bank, isn't really qualified to ask the right questions to know if their deposits are at risk if they happen to be above 250K. And, I've got a finance degree and an MBA. I don't feel qualified to be able to know that answer. And so for a depositor who's just putting money into a bank as a place to, be able to do their banking services, that's not a speculative and shouldn't be a speculative process or act. But now the investor in the bank, you as a shareholder of the bank, your investment in owning a bank, that's a speculative investment. And so like the SVB investors and stockholders, they got wiped out. That was appropriate. But for the depositors to get wiped out seems like a misplaced consequence to something that seemed like just an everyday event that they really weren't qualified to evaluate the risk of.
I agree. Absolutely agree with that statement. Yeah.
Okay.
Do you think we're I'm sorry.
No, go ahead, Jen. Sorry.
I just wanted to interject real quick. Do you think we'll see more banks buying other banks like UBS and Credit Suisse and that kind of thing to avoid more of this, or because they're going to be on sale?
Yeah, I think there will be. Well, first of all, the trend in consolidation has been tremendous over the last 20 years. We have half the number of FDIC insured banks as we did in 2000. So that trend's already been going one half. It's been going at a ridiculous rate, which is scary. A lot of communities are underserved and they will continue to be. But yes, I think in difficult times, you'll see more and more roll-ups, more banks getting bought up because of the very same reasons. First Republic is struggling. Silicon Valley, they get in a tight spot. They don't have the liquidity and the capitalization to weather a storm, and they need a rescue. It typically just doesn't happen as fast as it did in this one, where you can have time. So First Republic, for example, they're hurting for liquidity for very similar reasons. But that was a little bit slower burn because their demographic of clients isn't exactly Silicon Valley, but it's similar. And so they were able to kind of withstand more. And then what happened? Well, you had other banks step up and jump in and put $30 billion of deposits in because they don't want a systemic failure. Now that those deposits may turn into equity, maybe some sort of ownership, but you'll see more and more banks supporting and buying other banks up as they need to.
So this has been a trend since 2000, but you're thinking now it's going to ramp up even more.
Yeah. Okay. There'll be banks that are susceptible, and I'm sure we're going to get into this. What is your portfolio made up of? if there's a lot of real estate and the rates stay high for a long time, real estate's already hurting, it's going to hurt worse. Those banks are going to be really hurting. And there's some 2008 type policies or processes that we went through where, kind of extend and pretend, right? Just kind of push that loan out and hope it gets better. And some of that stuff and it worked, a lot of that worked. We may try again, but inevitably, there's going to be banks that are in trouble that are going to raise their hand and be like, we need to sell now. We're too far gone from a capitalization and liquidity standpoint, and we need some help. So I think we will see more roll-ups.
So bottom line, though, when you look at local and regional banks, they're not going anywhere, are they?
No, I don't believe so. And I certainly hope not. I believe, honestly, that the health of the banks right now are stronger than they've ever been. And it's unfortunate that these couple events have happened, but this stuff happens often. It's just not quite as flashy and glamorous and makes the news. But banks are better capitalized than they ever have been. The underlying assets, so it's interesting, Silicon Valley, their underlying assets and their underlying core cash flow, very strong. They didn't have credit issues. They didn't have a bunch of bad loans. That's typically what you think of a bank failing. They did a whole bunch of poor loans, didn't manage it properly and all that. This is a very different scenario from that. They were actually doing really well, and their investment portfolio that they maybe in hindsight put too much into, that came back to bite them in the butt when the Fed happened to jack rates higher than they ever have before. So there's some things that are making the situation look worse than it is. When you look at underlying credit quality, it's still extremely strong, especially in a regional and small bank platform.
Well, it was just a mismatch of timing, right?
Yeah.
I mean, so the investments were long-term and the demand on the deposits was short-term.
Yep.
And that was just a mismatch. Had they been able to go to the end of the term of those investments, they would have been made whole and everybody been happy.
Yeah. The new program that came out, the bank term funding program that came out as a result of this, and just for clarity, see, a bank can now pledge their assets. So their bond portfolio, treasury portfolio at par value to the Fed. The Fed will give you a low rate loan. If that had been in place before this, Silicon Valley never would have happened.
Wow.
Now, granted, it took that to happen for this new program to exist, but the Fed is starting to realize every bank's got this portfolio of high quality assets, very conservative, very safe. None of the stuff that we were doing, banks were doing.
Well, edit out.
We weren't started until mid-2008, so we weren't part of the problem. But that mindset is completely shifted. It's very conservative. But when you have a decade of free money and low rates, you're trying to find yield anywhere you can, and you get trapped in these long-term securities, and it bites you. But there's a lot of lifelines out there now, and I think it's important to bring up for everybody's benefit that banks now have the ability, if they need to grab more liquidity at low cost, they can go do that should they have problems. So that, to me, that with all the other credit strength and all that, tells me that it's very resilient right now.
Is any of this going to affect the underwriting of your loans? And when I say any of it, I don't mean just this most recent incident, but the raising of the interest rate with the Fed. Are you tightening up any of your underwriting procedures?
We are to some degree. So the biggest thing to look at, obviously, is just stress testing. And when you look at loans, and we'll speak to real estate here because obviously that's pertinent to y'all. When you look at the portfolio of loans nationwide, we're talking trillions of dollars, but you look at what's coming up for maturity, and we're doing this exercise. We've been doing it for the last 8 months. Do these assets still work? Because they may have been at 3.75%, 3.25%, 4%. Well, it's a lot easier to cash flow those types of loans than 8.5% and higher, 8%, whatever it is. So there's a big period of reckoning coming with a lot of these maturing loans. With that said, banks, at least this is our take on this, we're going to keep going because we need to keep replacing old loans with new loans at a higher yield because our cost of funds have gone way up. If we sit idly by and say, hey, we need to shut down and just weather this storm, the problem exacerbates, right? Because our cost of funds keep going up, but we're not generating more revenue. So I think a lot of banks have that same, the healthy banks that have the capital to grow have that mindset of, hey, we got to keep going, but we've got to get our yield on everything we do. Well, therein lies the problem on a lot of real estate deals we're seeing. It's super hard to cash flow these deals, even at a 60% loan to value. You know, there's a real disconnect out there, which I know you all have seen quite a bit. If you've got a debt yield sub 10 at a 60% loan to value, something's off. There's a disconnect.
Well, so when you were talking about that to me sounds more like an investment loan for a real estate investment as opposed to an owner occupied loan.
Yep.
So, and that's a distinction that we make all the time because, I mean, so you have one, which is, hey, I own a company. I need a place for my company to occupy to fulfill the obligations and the mission of our company. So your bank occupies a building. Our clients occupy office buildings, medical space, warehouses, et cetera. And so that is a different calculus than the investment. And so I totally agree with you. If you have a loan that's expiring, let's say if you're an investor, you own a building, let's call it a shopping center, even though we don't deal with retail typically. So you have a shopping center with long-term rents that go 5-10 years out, but your loan is expiring in 2 years. And you're looking at, you know, an increase from as you're saying, from 4% to 7%, let's say. Well, all of a sudden you're underwater. You may not be able to make that delta because not only are you having to pay a higher interest rate, but you also may not be able to get the same loan to value ratio that you had before. So you're going to have to pony up a lot more money and your cash flow is going to be negative potentially.
Yeah.
So, you know, that's where I see the biggest problem in commercial real estate and not so much on the owner occupied stuff. Is that correct or not?
Yes, I would agree with that.
Because I mean, we're running analysis all the time for lease versus purchase. And so a client will say, hey, I'm interested in buying a building, but with these interest rates, there's no way. I mean, we just can't afford it with these interest rates. And I'm like, well, have you looked at lease rates? I mean, and so we'll run that number. And I actually did this recently for a client and it was very interesting. I had in my spreadsheet, old interest rates still. And I think the old interest rate I had was like 4.75%, 5%, let's call it. And
when you say old interest rate, you mean from this morning or last night? Just trying to make sure.
Yeah, old interest rate from last year. Anyway, and it went up by 2%. And the metric that I look at is how much can you buy a building for as a percentage of the cost to lease it? So if it's equal, you know, if the cash flow out the door is the same amount for buying it or leasing it, you should buy it because guess what? At the end of the day, you'll own that. And when you lease it, you don't own anything. Yeah. So it's better off for them to lease it. Well, it was anywhere from, you know, and you know, the prior last year, it was like 60 to 80% to buy a building versus the cost to lease it. So that made all the sense in the world. Well, raise interest rates by a 2% interest rate increase. It only changed the percentage by maybe 5 to 10%, meaning now instead of it being 70% of the cost to lease, it's now 80% of the cost to lease. But guess what? It still resulted in the same decision point, which was you're always better off buying than leasing if you're comparing apples to apples building.
Yep. I absolutely agree with that. Absolutely. So, and just to clarify to Jan, to your question, are we tightening up our credit? In some regards, yes. In other regards, it feels like we are to a lot of clients, but that's just the interest rate that's doing that. It's not necessarily our standards. there's times where it's like, well, I can't believe you're requiring me to put so much money down on a building. Well, in normal times I wouldn't, but it doesn't cash flow at 80%. So you've got to go down to 60, 50%. And I'm not, I may not in a certain circumstance be as worried about the equity payment as I am the ongoing NOI that can service the debt. But that's just how the numbers work out in this rate environment. And to your point, Bob, on owner occupied, banks like ourselves, and there's plenty of them out there like us, especially in North Texas, that are healthy and growing. We want to do these all day long. There's definitely in our mind a little bit different risk profile for owner occupied real estate versus investor for certain.
Yeah. We deal with that a great deal. And it was kind of funny. Last year, we had a medical practice, a practice of doctors that wanted to buy a building. They'd been leasing for 20 years and finally decided it was time to buy. So we went out and found the perfect building for them. I mean, it was the right size, the right location. It had been finished out mostly the way they needed it previously. So we would have to spend a little bit of money for renovations, but not a dramatic amount of money. And so we did the whole analysis and introduced them, or they talked to their bankers and they got a price quote from the banker and we ran the numbers and they're like, oh, I don't think we're going to be able to do this deal. I'm like, why not? I mean, you're going to be able to buy the building for 70% of the cost to lease it. And then I also ran the numbers comparing the cost to buy the building versus staying where they were and leasing them the building they were in now, which was in a medical office building on the campus of one of the hospitals. And they said, well, we can't do that deal because, I mean, our payments are going to be higher than what our rent would be. And I was like, okay, but that's because you aren't willing to put any money down. You want 100% financing.
Right.
And I was like, you can't have it both ways. I mean, if you're going to put a normal amount of money down, then your payments would make sense. Right. And they were like, well, but we don't want to, all their investments were illiquid. They didn't have any liquid cash to put down. And yet they found, that they were able to get the loan still, but they weren't able to get the loan at a total dollar amount that was less than what their rental payments was. So guess what? They signed a lease for another 5 years, even though their cash flow out the door would have been a little higher because they weren't willing to put the money down. It still was cheaper to buy the building than to lease.
Yep.
Well, you're talking long term. Doctors are just here to heal you today. Tomorrow it's something else.
Okay, that makes sense. But I guess my point is that the numbers still work, but it's just a question of, do you want the savings in the long run or the short-term cash flow? But, if you put a reasonable amount of money down, then you get both.
Yeah, absolutely correct.
So I guess when it comes to looking at somebody wanting to get a loan for whatever real estate transaction, whether it's owner occupied, whether it's an investment, do you see that the timeline is going to be dramatically different to make that loan happen?
Yeah, are you talking about in terms of the actual process for underwriting and getting it approved?
Right.
It shouldn't. There may be some banks, in my experience in the past, larger banks can be a little slower to move. You may have very ambitious bankers that are out there trying to, hit their numbers, hit their goals, and they're going back and they're fighting with credit committees or whatever it may be, waiting on mandates. The smaller banks and the regional banks are typically more nimble, more of the ground floor people on the firing line, so to speak, understand the credit culture and where you are in terms of your decision making. So, for example, for us, it's not going to take us any longer at all to make a determination. The metrics have just changed a little bit. It's going to be, I pride myself and our team on quick and candid no's. Rarely do we give a no, but it's more of a, here's what we can do, may not be what you're asking for, and providing some guidance on, here's what you ought to strive for, maybe try this bank, or this bank, and send out, oftentimes in this environment, clients sometimes need to hear it from 3 or 4 different angles before they believe it, and you all probably experience that as well. But some of the things that I think will get tougher We've talked about real estate, so owner occupied, we're going to continue to do as much as we possibly can. Investor real estate, we're going to be more selective. I think everybody's going to be more cautious with office, obviously, versus industrial type space.
Yeah.
Then when you look back and you think, okay, well, what's the big picture here? Rates are up. People are burning through cash a little bit faster than they were before because of inflation and interest rate environment. So banks want to be really diligent about how they're deploying their capital. You want to put it in the assets that you are most comfortable with as a bank, the best yield, the safest return, all that good stuff. So when you think about things that involve real estate, like a TI loan, a finish out loan, and I'm empathetic to tenants and buildings that, hey, we need some debt to finish out our building. Well, you may see a bit of a slowdown from banks willing to offer that, because again, they've got this bucket of capital they want to deploy. Whereas before it may be a huge bucket, or we know it's going to refill, we'll just go as fast as we can. Even the well-capitalized liquid banks now, just because of the environment, are going to be a little more cautious than they were before. Not that it doesn't mean they're bad loans. It just means there's other places they'd rather allocate those funds. And so when you think about TI loans from a bank's perspective, they're pretty much unsecured, right? And so if you can go get a secured loan with cash flow for the same rate as an unsecured loan with cash flow, which one are you going to choose? Yeah. Especially when you're being scrutinized every single day. So that's just something to keep in mind if you're, new businesses are moving or going into new buildings. You've got to think about all those things ahead of time. And does the landlord, do they have the ability to help with finish out? Do they have the capital to do that? Those are all questions that need to be hashed out early on.
And you raise a great point there, because TIs, and for the listeners, that stands for tenant improvements, in case anybody didn't realize that. So that's an ongoing problem. We were already seeing in office buildings, particularly, landlords that weren't able to fund tenant improvements. Yeah. We have a client that's a law firm in a building in far north Dallas. We had been trying to get this lease extended. It's an existing tenant. I mean, the tenant's been in the building for 20 plus years. So we're trying to get this lease extended, and it had a very, very small amount of improvements required. I mean, like, build this little demising wall across the hallway, recarpet some of the space, and paint. I mean, very, very minor requirements of the landlord. And yet we could not get them to give us an answer. It took months and months and months to get anywhere. Finally, the client said, you know what, it looks like one of our partners is not going to retire after all, so we'll keep all the space. So I called the leasing agent. I say, hey, we can keep the whole space. And they decided they're not going to ask for the carpet and paint because they don't want to disrupt the office. Yeah. I mean, bam, we had the renewal amendment from the landlord in record time. And so, Jan and I and our other team members, we've been talking about this, and we're like, we think that there's a problem with this landlord, that they just don't have any money to spend on improvements or commissions. And I talked to a couple of other tenant rep brokers in the market, and we were all commiserating about this particular landlord, and we all agreed that was in fact the case. So when we found out that was that they weren't gonna, that they were gonna do the deal without the TIs, and we got that amendment so fast, I contacted the leasing agent, and I got a bounce back email. So-and-so is no longer with the company. Please contact this other person instead. And I'm like, oh my goodness. So they're now laying people off. So I called the new person, who fortunately is somebody I've known for a long time. And I said, okay, you guys don't have any money for improvements, do you? She's like, no. I said, so do you have any money for commissions? That's a little important to me. Yeah. And she's like,
you're a good guy, but not that good of a guy.
Not that good a guy. And she's like, we don't. And I'm like, oh, okay. So one of the things we then ask for is what we call offset rights. So we basically said, all right, then the tenant and the lease amendment, we need to have a provision that says that if the landlord doesn't pay us the commission, then the tenant has the right to pay the rent to us until we're paid off, and then they'll start paying you, the landlord, again. Now, from a from a lender's perspective, do you have loan covenants in your loans?
Ben's already shaking you off.
Yeah, you're like, there ain't no way in hell I'm going to let you do that.
Not okay with that.
I don't want to hear that, Ben.
I respect where you're coming from, and I would do the same thing if I were you, but that's why, banks, we review the leases ahead of time, but ideally, when you're underwriting these types of deals, investor real estate, you're planning for the unknown, right? That's what a really good banker does. You underwrite foreseen risks and unforeseen risks. And so you may think, well, how in the world do you underwrite for unforeseen risks? Well, the best way to do that is just margin, right? Have margin going into deals where there's enough flexibility when times get tough, where you can pivot and provide additional capital, and it doesn't take the deal undervalued. So, but to your point, it's a delicate situation, because as a lender, I want that building leased up, right? It's not worth anything to any of us if not. So we want to make sure that those leasing agents are paid. We want to make sure you can do reasonable TI. Otherwise, what's the point? But you can't do that if you're already at the cliff's edge. And then that's where the problem is. So, I would look at that lease and I'd say, unless you bring in more capital, owner, we can't approve this lease.
Yeah.
We can't go somewhere else.
So then the other piece of that then is, what if the landlord isn't maintaining the building? And, I represent the tenant, of course. So I want to make sure the tenant has the flexibility to pay me, and also to pay for anything that needs to be done that the landlord hasn't done. And, because we've seen this in the past where the landlord is in a cash crunch and they just quit maintaining the building, and the building starts to decline. Yeah. And I've actually told landlords in the past, I'm not showing your building ever again until you fix, X, Y, and Z. And so I imagine for those kinds of things, you have the same issue. And I mean, as the lender, that puts you in a really hard spot, because now you have a declining value because they're not maintaining it.
Yep.
And the building is going to start emptying out if brokers know that that the landlord is not paying for improvements and commissions. I mean, at what point do you step in and say enough's enough?
Yeah, that's a great point, Bob. Right now, we're about to see some degradation in values anyway, right? Just because the market cap rates have got to come up. I got an appraisal the other day, by the way, that had a five cap on it. Like, how does this work? But anyway, they're starting to change now. They're starting to go up. So you're seeing the drop. But to your point, we need to protect the value of our asset, the condition of it, the leases, and all that. So again, that goes back into your initial underwriting. Did you build enough margin into this? And hopefully you've got covenants in there that are appropriate, that are really clearly defined, where it allows everybody to come back to the table quickly, sooner than later, to say, okay, you lost a couple leases, you're below your NOI coverage hurdle or percentage, whatever it is, get back to the table quickly and force something to happen. Either get your act together, bring in some capital, or we're going to make this just a quick insight. I don't ever really want to take back anybody's assets ever. That's the last thing I want to do. I want you to succeed and be happy and healthy and all that. If for some reason you want to leave or you want out, I want somebody to come in and refinance me. That's the path of least resistance for a bank. We don't necessarily want to own and run real estate. So what a bank will do is they may step up the interest rates. They may tighten things up to a point where it's uncomfortable, where you feel inclined as the owner to go find, additional financing or separate financing and repay that note. Now that won't help the situation of the building, because if they go find another source of financing, more than likely it's going to be even more stringent, more expensive than the senior debt, which is only going to exacerbate the problem.
So one other way that we try to protect clients is that we put in a subordination and non-disturbance and a torment agreement into the lease, where the landlord has to get the lender to sort of preemptively say, if I ever foreclose on this building, I won't terminate this lease, because lenders have the right to terminate leases if they foreclose on a building. And this actually was a good thing recently. We had a client that was in a building in Dallas on LBJ Freeway that last year went deed in lieu of foreclosure, and we had gotten an SNDA on that lease because it was a sizable deal. I mean, I know we can't get this on every little tenant, but this was a pretty sizable deal. But this was a big building that, you know, it was actually a 3-building complex that had gone to deed in lieu of foreclosure. So we were, you know, really happy that we had the SNDA to protect that client. Now, in a deed in lieu of foreclosure, of course, you don't have the right to terminate leases, but there's also no reason that once you go deed in lieu of foreclosure, you can't go to actual foreclosure and then have that right. Either way, you know, we want to try and protect the client. From the lender's perspective, what do you think when you receive an SNDA and you're asked to sign that?
Well, again, I guess it goes back to the amount of margin we've got going in the deal.
Okay.
You know, typically when we're looking at investor real estate, we're not developers, we're not leasing agents. I want a building with an existing lease. As long as it's, you know, at market or near market and it cash flows, I'm inclined to have that lease stay there, because otherwise you've got speculation, right? I've got speculation that, you know, you hear all the time, well, don't worry that the building's empty. I'm an expert at leasing this thing up. And by the way, the rents that were in there before, I'm going to get 40% higher than that. That all sounds wonderful, but it hasn't happened yet. So I would take a lease in hand as long as it cash flows and we've got enough margin in the deal from a cash flow and a leverage standpoint any day of the week.
Well, and in my real estate career is almost 40 years now. My first 20 was on the landlord side, and then the last 19, you know, going on 20 now on the tenant side. I've only seen, I think, maybe twice or 3 times in that entire time where a lender foreclosed on a building and terminated a lease. And, you know, for the reasons you're saying, and of course, the first time I saw it was in the late 80s, early 90s. So that doesn't really count because that was just such a weird time anyway.
Before Ben went to college. I'm sorry, go ahead. I digress.
But yeah, no, but it was really an issue because, you know, people were doing such dumb deals. I mean, I saw a law firm that had 2 years free on a 5-year lease, no personal liability from any of the partners, and the landlord had spent an ungodly amount of money for improvements.
Yeah.
And probably paid to move them in.
Probably, and maybe thrown other stuff at them. And so when that one got foreclosed, the lender immediately terminated that lease,
Sure.
as they should have. But because, you know, it wasn't generating any income to start with.
Yeah.
So why let them sit there?
Yep. Yeah.
So what, from your perspective, are there other things that need to be considered that we haven't talked about from a real estate borrower's perspective? If a landlord or investor is coming to you, what else should they be thinking about that we haven't already mentioned?
You know, the first thing I would want to know, you know, putting on my entrepreneurial hat, I would want to really understand the culture of a bank before you get in there. What are their intentions? What's the makeup of their board? Do they have great oversight with banking experience? You look at some of these recent collapses and you see a whole bunch of fairly talented people, but maybe not in the areas of expertise that they needed for oversight. I'd want to look at all the banks. Every bank is required to make their financial statements public, and you can find those as they're called UBPRs, Uniform Bank Performance Reports. And you may not be real familiar with financial statements, but you know, I think it's still helpful to look at them and look at trends over the years, look at their liquidity, because you want to make sure you're getting in a bank that looks viable and healthy for the long term. If you've ever experienced this, being a client at one bank that gets rolled up by another bank can totally change everything that's happened for you. So I would want to know the key players of that bank, the decision makers, understanding their mentality when it comes to underwriting before you get too far along. And then frankly, ask them, you know, who's got an appetite for this type of transaction? Because you don't want to begin the process, waste a bunch of time with somebody who's then going to end up coming back to you with a term sheet that does not work at all. So those are the kinds of things I think I'd keep in mind. And that, just understanding it's going to be tough. It's going to be tougher than it was from 2012 to, pre-pandemic. Those were not normal times. And I think we've been conditioned that that's how deals work. Well, that's not really how deals should work. There's a lot of unprudent stuff going on, and a lot of deals went through that really had no business going through. And I think we're going to get much more conservative as a general economy here in the country. And you just need to be prepared for that when you start to analyze your numbers.
So let's say I'm an investor, and a limited investor, whether it's into a real estate deal or it's an operating company or a startup, whatever it is. Should I be asking the question who you banking with to whoever the sponsor of that investment or company is? It feels like that's getting very invasive to a point that I'm no longer a passive limited investor now. I'm asking where these people are putting their bank and just the deposits. Should I be asking that now?
I would, even before all this happened, but I'm a banker.
Of course you would. You're a Boy Scout.
Yeah, well, and that's the area that I understand. I would ask that question. That's low on my list. My question is, if I'm investing in, say, an operating company, I am scouring the financials. I'm looking at their balance sheet. Do they have enough hay in the barn, so to speak? Can they weather a storm? You look over the course of history for individuals and operating companies, and the massive amount of wealth that's generated is always after a down cycle. It's those who have liquidity and fuel and a strong balance sheet that come out the other side, and they take the best employees, they take the best market share, you name it, they roll up, they buy other companies. So that's where my focus would be is, what is the health of your company, your building, whatever it is, first and foremost. The rest of it, in my opinion, kind of depends on your investment criteria. If you're looking to make a buck today, good luck. It's hard. There's not going to be a lot of real estate deals that can pay you a big distribution right now or a big dividend. But if the deals that we're seeing go through are from high net worth individuals or groups of individuals that are like, I don't care if I see anything for a couple of years. I'm playing the long game. This is the right purchase at the right time. And we know what the appreciation is going to be, or we have a feeling what that's going to be. So we're moving forward. Those are the types of deals we're seeing a lot of. But otherwise, stay liquid, park your deposits over here. We're paying a very nice return on that, nice and safe, fully FDIC insured if you want it. And then I think a lot of folks are starting to wait to see these values come down a bit.
Is there an upper limit on the thing you talked about where you spread that risk around? So, you're fully insured. Is there an upper limit? If I came in there and I had, $50 million, that's a lot of $250,000.
You've got $50 million?
So there is
you missed the big if there, Jan. There was if I had.
There's a limit, and it will affect you, Bob and Jan, but not most people. It's $150 million.
Oh, well, if that's all we're talking about.
It's going to be tough for you.
Gonna have to call someone besides Ben.
I'll help you out. But yeah, it's up to $150 million.
Okay. Wow. That's pretty high though.
Yep.
That's incredible. Because one of the things I've heard is that some venture capitalists are potentially going to start telling the companies they fund, you have to put your money, the deposits, into one of the big fours just to eliminate all the risk. And if they do that, then that's going to certainly hurt the local and regionals. But given the program you're talking about, that's kind of silly.
No need.
Very few startups get $150 million investment. So
correct.
They can be just as safe as being in one of the biggies.
Yep, that is correct. And that's, thank goodness there's products out there like that. I wish it wasn't necessary, but because of what happened, you can see the fallout. People are going to flock to the big banks. Most people would say, in my experience, the service isn't great. They don't they don't have a banker. They don't have this. They don't have that. It sucks. But I'm so scared that this is what I've got to do. And so until we as an industry can demonstrate the health of where we are, because it is vastly different than 2008. This is blasphemy, but I'll say it anyway. I'm not a huge fan of ongoing and building and growing regulation all the time, but a lot of that regulation from 2008 worked. Banks are immensely better capitalized than they were before.
So speaking of that, though, what happened in 2018? Because I keep hearing, these people on podcasts and stuff talking about everybody to blame, regulators and the management of the banks, et cetera. The stupidity of the depositors for going over the insured level, which is ridiculous. But what was the regulation that was rolled back in 2018 that some people are blaming for part of this?
Yeah, Bob, I can't specifically remember what that was.
Okay.
It wasn't anything hugely monumental. And of course, when things like this happen, people needle, and it's so easy to be the armchair quarterback and look back and, well, if this didn't happen or this or that, it's really easy to do. And there's so much speculation about what happened. But the reality to me, what needs to happen is not necessarily more regulation, but more oversight. There's some regulation that frankly isn't being followed as closely as it should be by different levels of the industry, of the market. So a big bank may be more highly scrutinized on this aspect, where a little bank isn't, and vice versa on some other regulation. But to me, it's so important that you got an executive management team and you got a board that is highly attuned to what's going on. That you got a chief risk officer and chief compliance officer that stays on top of all this stuff, because a lot of it is really great stuff. Some of it is not so great. I mean, the road to hell is paved with good intentions. So a lot of it is actually harmful to the economy and to clients, but some of it's really good. And most banks, again, you're hearing it if you read and pay attention to the news, all these banks are looking around going, yeah, we don't love the environment either, but our ship is in way better shape than we ever imagined, especially compared to the past.
Gents, thank you for your time. We got to let Ben get back to making loans, and Bob's got to go find some more tenants.
You guys get that 150 million over here this afternoon.
It's already there. What are you talking about?
Perfect. Okay. Uh-oh.
Thanks to all our viewers and listeners. We appreciate your time, and we'd really like to give a big shout out and thanks to Ben for his expertise and his time today.
Thanks, Ben.
Thank you.
Bye. Thank you for listening. And just a reminder to send in questions to see if we can stump Bob.
Not going to happen.
We really appreciate your taking the time to tune into this episode. We would love it if you would give us a 5-star rating on whatever platform you're listening to this on. And if you are on our YouTube channel, we would love to read your feedback in the comment section. Also, be sure to subscribe so you get notified when we publish new episodes. Thanks, and see you next time.
Bye.